Hey guys, how's it going? Today I'm going to show you how to calculate the intrinsic value of a company. To be able to invest like Warren Buffett, you need to be able to buy wonderful companies at attractive prices. And the only way to find out what an attractive price is if you know what the value of the company is. Once you've figured out what the intrinsic value of the company is, or what the real value of the company is, your goal is then to buy the company at an attractive price. An attractive price is just a price where the price you pay is less than the actual value of the company. If the company's real value is $10 per share and you buy it at $7 per share, well then you're buying at an attractive price because you're buying for less than what the company is actually worth. When calculating the intrinsic value of a company, it's impossible to get it exactly correct. Warren Buffett himself just aims for a good ballpark estimate. Calculating the intrinsic value has a lot to do with future expectations of growth and earnings and free cash flow, and these are impossible to predict today. I'm going to be going through an example of a company that I have in my portfolio and how I calculated the intrinsic value for this company. I learned these methods by studying Warren Buffett and also by reading this book by Phil Town. If you want to learn more about these methods, the link for this book will be in the description. But let's head to the spreadsheet and get straight into it. The company we're going to be analyzing today is AB InBev. It is one of the world's largest breweries and they have a huge selection of beers and some of them are really good. But that is not the reason why I actually invested in this company. The reason why I have this company in my portfolio is because I was able to buy them at an attractive price. And I was able to do this because I calculated their intrinsic value and I was able to buy them when their price was less than their intrinsic value. So I'm going to try and make this into a series of different ways to calculate intrinsic value because as you can see, we have around 5 different ways to calculate intrinsic value. If I was to do them all in one video, it would be way too long. So I'm going to do each one in a different video and hopefully using different companies. So if you guys do want to see that, please do let me know in the comment section down below. But let's get straight into it. The first method and the one that we're going to be covering today is the margin of safety discounted cash flow method. So I'm going to give you guys a brief overview of this method and then I'm actually going to explain it in much more detail. So don't worry, by the end of this video, you'll actually be able to understand it. So what we're doing is we're taking the earnings per share of the company. And if you don't know, earnings per share is just the net income or the earnings that the company makes, and dividing that by the number of shares. So we take the earnings per share, we're going to grow this 10 years into the future, and the growth rate we select based on our knowledge of the company and the future prospects of that company. Then we times this earnings per share by a price to earnings multiple in the future. So every company in the stock market has a market capitalization, and this is found by taking the price per share and timesing it by the number of shares. And this market capitalization is essentially the value that the stock market is giving the company. The value that the stock market gives the company may or may not be the actual intrinsic value of the company. For every company on the stock market, the price per share is determined by the earnings of the company times a multiple. So for example, if a company makes $1 in earnings per share and has a price to earnings multiple of 15, this company's price per share is going to be $15. So that's how it works. That's why we take the earnings in the future and we times it by a price to earnings multiple that we predict the company will have in the future. Once we've taken the earnings per share and we times it by the price to earnings multiple, we then get the price of the share in the future. So in 10 years, based on my calculations, the price per share in the future would be $146 per share. Now what we do is because we want to buy the company today, we then discount this back to the present day, taking into account the rate of return that we want to achieve, which then gives us an intrinsic value of the company of $43 per share. Then we apply a margin of safety where we buy the company at less than what it's actually worth to protect us from mistakes. Okay, so I know that's a lot of information and a lot of it might be very complicated, but don't worry, I'm going to go into all the little things in a bit more detail right now. So for AB InBev, their last year's earnings per share was 4.53. To find this for any company you want, you just type in the company's ticker symbol and stock, and you can go into Yahoo Finance. So here you would see that this is where the earnings per share would be for the trailing 12 months. So it means from today to 12 months ago. However, I'm using the earnings per share from the year of 2019. This is because currently with the coronavirus, I don't think it's an accurate representation of AB InBev's actual earnings, because with the coronavirus, almost 50% of their revenue has been taken away because 50% of the revenue from these beer companies, it comes from sporting events, clubbing, going out, parties, and a lot of these things cannot obviously take place currently, and that's one of the reasons why their earnings have been depressed in the past 12 months compared to last year. So, and what we can do is we can actually click on their financials and we can scroll down and we can see that their diluted earnings per share was 4.53. So that's what we're actually going to use in our calculations. Now that we have the earnings per share, we need to determine a growth rate that we want to choose for our company. You can look at analyst expectations on Yahoo Finance. So you have your company on Yahoo Finance, you click on analysis, you scroll down and you can see that for the next 5 years per annum, analysts are predicting that AB InBev will grow by 10% every year, almost 11% here. What we can also look at is the big 4 growth rates. Essentially what these growth rates are, it's just the growth rates of different financial metrics for a company. And if you look at here, the growth rate over 10 years for net income has been around 9%. For book value, it's been around 5.8%. How do you figure out the growth rate over a 10-year period? So what you do is you actually have to use this formula right here. You have to take the ending value, then you have to divide it by the starting value. You have to raise this to the power of 1 divided by the years and minus this by 1. confusing, don't worry. Here's what you actually do. So what we do is we can go into Morningstar. This is a really good way to look at financial data for companies, this link, and it can be used for any company by just changing the ticker symbol right up here. So what we want to do is we can look at the net income, for example, from 2019 to 2010. 9171, divide this by 4026. Then we're going to put this to the power of 1 divided by the number of years, which in this case is 10 years. And then we're going to minus 1. And so what we get is this here, and we can just put it in a percentage. So we know that every year in the past 10 years, the net income for AB InBev has grown by around 8.5%, which is relatively high, and that's pretty good. And this is sort of in line with what analysts are expecting in the next 5 years. Another thing you can do to actually determine the growth rate for this company is to look at the growth rate in the industry itself. So this is just some statistics that I found on the actual beer market. If we look at it, revenue in the beer market is expected to grow by 9.4% in the next 3 years. So this is again somewhat similar to what analysts are expecting. And this is where your sort of knowledge of the company and your further background research can also impact what you choose for the growth rate. So I know they have a lot of debt because they made a huge acquisition of another beer company in 2017. And because they have so much debt, it's gonna be very hard for them to actually grow at such a high rate because they're gonna have to be paying back this debt. And that is one of the reasons why I don't believe that they'll be growing at such a high rate. I might be wrong, but I'm going to be more conservative and say that they're actually going to grow at around 6%. So what we do is, since we have the earnings per share in the first year, we're then going to grow the earnings per share by 6% every single year until we reach year 10. So how we can do this is we take this previous value and we times it by 1 plus the growth rate. What we have to do is we have to make sure this growth rate stays the same. So what we do, we have to make sure that this cell doesn't change. So we put 2 star symbols here before the B and after the B. It just makes sure that the growth rate will stay the same in between all of these cells. So then what we do is we can just drag this all the way to here, and you can see nothing changed. So now if I was to change the growth rate to 10%, all of this would change as well. And don't worry, I'm gonna be leaving this spreadsheet in the description so you guys can use this yourself and calculate the intrinsic value for a company that you want. Now we have to decide the future multiple that we want to use. So how I actually chose this was I looked at the past historical price to earning figures for AB InBev. And what you can do is you can go to a website like Macro Trends. You can type in the company's ticker symbol and you can click on price ratios. Here are the price to earnings ratios all the way going back to 2010. So you can take all these values, you just sort of highlight them, bring them into the Excel spreadsheet, calculate the average value over the period. So what I actually found out was this average value was around 18. So I'm just gonna use that in my calculations. But one thing to take into account when you're actually using the future multiple is that the multiple of a company, like I said before, does have a lot to do with their growth rate. And so one thing that Phil Town says in his book is that one way to actually figure out this future multiple is to just double the growth rate, because that's what, from his experience, that's what he's found to work out for the actual multiple. So if it's growing at 6%, you want to use a price to earnings multiple of around 12. Knowing a bit about the brewery industry, AB InBev is the world's largest brewery. They're one of the most efficient producers in the market. They have an extremely great net and operating margin. These are some of the factors why I think the earnings multiple in the future will be above 12 and it'll be something more around 18. As you can see, we took this earnings per share, we now times it by 18. So just to show you guys it changes if I was to change the multiple. And now what we have to do is we have to discount this back to the present day. We're trying to discount the future price of the company in order to get the price that we should buy it at today, or its intrinsic value today. And how this works is we are using a discount rate. This discount rate takes into account the rate of return that we want to achieve and also inflation. If you want to achieve a 10% rate of return, you would change this discount rate to around 10%. As you can see, the value of the company today actually increases. This makes sense. If you want to achieve a lower rate of return, the price you can buy it at today can actually be a lot higher. However, if you want to achieve a greater rate of return, you have to increase your discount rate to take this into account. For example, if I wanted a 15% annual rate of return from investing in this company, the value today based upon this 15% rate of return would be a price of $36. So the discount rate that you use, which is essentially the rate of return that you want to achieve, you can think of it that way as the rate of return that you want to achieve. The higher it is, the lower price you'll have to buy it at today, and the lower it is, the higher price you can actually buy it at today. Phil Town mentions in his book that he uses a 15% discount rate because he wants to achieve a minimum of 15% when he's investing in an individual company. This might seem high, but it does actually make sense. If you're taking on an individual risk to invest in a specific company, you want to be compensated for taking on this extra risk. You want to be getting returns way greater than the market. And historically, the market has returned anywhere from around 7 to 10% each year. So you want to be getting at least double that, so around 15%. So in this example, I'm going to use a 13% discount rate because AB InBev has around a 2% dividend yield. So each year you're going to be making 2% from the dividend. I would be wanting to make 13% from the earnings growth and the price appreciation of the share in the future. 13% for that, and then 2% for the dividend gives me a rate of return of around 15%.
Quick maths.
At 13% value today, if I was to buy it and wanted to achieve a 13% rate of return, I would have to buy this company at around $43 today. Now what we do is we can apply a margin of safety. And so a margin of safety is just the difference between the intrinsic value of the company and the price that you are buying at. So this difference protects you from a bunch of mistakes. The management could mess up, your calculations for the growth rate could be completely wrong, your earnings multiple in the future could be completely wrong, and this margin of safety protects you from these things. The higher the margin of safety, the more mistakes you can potentially make with your calculations and still achieve a decent return. The margin of safety, think of it as a function of quality and growth. If a company is growing faster and has a higher quality, you can have a lower margin of safety. If a company has lower quality and not growing as fast, you would want a higher margin of safety. In my opinion, AB InBev is a very strong company, and that's why I'm only using a margin of safety of around 20%. And I'm also being a bit more conservative on the growth rate. So that's also one of the reasons why I'm using a lower margin of safety. But Phil Town does recommend a 50% margin of safety. However, in this case, if I was to use a 50% margin of safety, I would only be able to buy AB InBev at around a price of $21. If you look in the past, the lowest it's really gone to recently is around $35. The probability of it going to around $21 is very low. That's what happens when you choose a higher margin of safety. If you choose a higher margin of safety, the price you can buy it at is a lot lower. And the problem with this is that potentially you will never actually see the company get to that margin of safety level. So you'll never actually end up buying it. That's why it can be a problem if you're being too conservative with your estimates. So now you guys know how this method works. So just to recap, basically what we're doing is we're taking the earnings per share today, we're growing it 10 years into the future, we're then timesing those earnings per share by a price to earnings multiple, which we think that that company will have in the future. We then discount this back to the present day using a discount rate that incorporates the rate of return that we want to achieve with this company. And then we apply a margin of safety on top of that. So we reduce the price that we buy it. So the price we are buying is an attractive price where the price we're buying is less than the intrinsic value of the company. And so that's the benefit of actually knowing what the value of the company is. You don't have to worry about the stock price so much because you know what the actual value of the company is, and you don't have to worry if it goes up or down. You can just wait until the company gets into a good buying range based on your calculations. The one sort of critique I do have about this individual method is that it might be a bit too conservative sometimes. However, being a bit more conservative isn't necessarily a bad thing. It will force you to invest in less companies, which will make you more selective in choosing great companies, which over the long term would be a very good thing for your portfolio if you're only choosing really high quality companies with really good rates of return. That is it for this margin of safety method. I hope you guys have enjoyed, and I hope that you guys have understood this and you're not able to apply this to a company of your choosing. I'll leave a link to all the different websites like Morningstar and Yahoo Finance in the description so you guys can look at that. I'll also leave a link to this Google spreadsheet. I'll only include the margin of safety calculations, and then in the next video I'll include the next method and the method after that. By the end of this series, you guys will have access to a Google spreadsheet that has all these different methods. So instead of having to do this all yourself and doing all these calculations, you can just use this spreadsheet to actually calculate the intrinsic value of some of the companies you want. And no, I'm not charging anything for this. It is completely free. So I hope you guys do enjoy it and do actually use it, because it's very important to actually know the value of the company before you invest in it. I hope you guys have enjoyed. And if you have found this useful and you do use the spreadsheet, please do smash the like button and hit that subscribe button. It does really help. I really enjoy making these videos and I'm going to keep doing them. So thank you guys so much for all your support, and I'll see you guys next time.